Hello, Baker, Advanced Financial Planning students. So I hope everyone had a good weekend, and we are now moving on to week 3. So these classes go so quickly. So this week, kind of rinse and repeat. So make sure to do your quiz, do your homework assignments, and then engage in the forum discussion, and you'll start thinking about that final project. Now we have about still 5 more weeks to go before it's due, but start thinking about, start approaching it. That way it's less taxing, if you will, when you get to that period of time. So this week you have readings in chapters 7, 8, and 9. I want to go over some of the highlights of these chapters because it deals with obtaining credit, also getting loans, how to protect yourself, if you will, and making good choices. So first, just the concept of just obtaining credit. I remember many years ago, back in the 80s, I think the first loan I ever got were some for some Infinity speakers. They were really nice speakers. My mom was worried about me at the time going out and probably not making much money, but I was able to pay them off. It was probably at a super high interest rate of 20% at that time, but it was my first installment loan. And eventually I did pay them off. In that time in the 80s, I think they were about $400. So it was an expensive purchase, but it was a lesson learned too about credit. So, but with this, most of us are kind of used to installment loans. It could be like a car where we now pay, so a period of even some places up to 7 years now, and cars are so expensive. Or a revolving line of credit. Most of us are familiar with that with credit cards, and there are many Americans that do use continue to keep a balance on a revolving credit card. It's not something that I advise to do. The industry makes a lot of money. They call it the sweet spot for those that keep the balance, and I think it's a pretty large number of Americans. I think there's something like 20 or 30 million Americans that just pay the minimum balance each month on their card. So, but I would kind of I like how the chapter stressed this. It's just being smart about what you're purchasing and accumulating debt. I always love a video. I think it's from a TED Talks. I think it's Graham Hill talks about less is more, and it's about this accumulation of stuff. And I even look at my garage sometimes. We've probably inherited it more from relatives, but it's hard to walk around the garage because we have so much stuff. And it really begs the question, does this stuff really make you happy? It's good to have some nice stuff, but how often do you actually use this? So before you buy that next thing or put something on credit next time, is this really going to make me happy in the long run? So just be cognizant of that. And that way, because we find that individuals that have higher levels of debt have higher stress, they're not as happy. And some would argue that it just adds more to pollution, if you will, negative externalities. So just be wise about it. But with credit, obviously there is what we call like a FICO score. It's actually a logarithm that determines your credit score. And think of that credit score as a barometer of what your borrowing cost will be. So obviously the higher your credit score, those in the 800 ranges would have the lowest interest rate offered to them, and those with the lowest scores would have a much higher interest rate. So again, it kind of measures or barometer to what you're going to pay. So that's why you want to have good credit and try to maximize that score. And then there's 3 major companies: TransUnion, Equifax, Experian. I worked a lot with them at the early turn of the century. I remember going down to like Texas and Florida, and at Sprint we used them more for when people used to write a lot of checks. What they did is they would check the credit worthiness of the check writers, and if as long as we followed the procedures at the stores when we accepted checks, if the check did go bad, TransUnion or Experian would refund us the money for that. But again, we weren't necessarily checking bank accounts. They can't do that. They just look at the credit history. So, but lenders, they're going to look at those credit scores, and they're going to use that again to kind of determine what interest rate is appropriate based on the risk they're taking on with you. One of the big things these chapters talk about was identity theft, and I've been a victim of identity theft. It's so easy today, where I had to get myself reissued a new credit card. The way criminals can do it this day, they just all they need is your card number, some information. They could swipe it at a gas station if you don't even know it. But I think it was locally, like for some reason they were doing it at Walmart. They'd only charge like $30 or $40, even with the cameras and everything that they have at the stores. When I contacted the police would pretty much just we don't deal with it, So it's just a big loss to the industry. I know the textbook said you can call the police, but the reality is they're probably not going to do much about it. So they talks about whether how much you need to maybe invest in protection, how you want to make sure you protect your information, be aware of different scams, especially on the internet. Even with my son, I was telling him he bought something for some necklace on a website, and I said, this website doesn't look so legitimate, so you got to be really careful about what you're sharing out there in information, because it looked like some guy was doing an operation out of his garage in Boston. So I said, just the kind of lesson learned, hopefully it is all legitimate, but when you share information like that, especially over the internet, it's kind of available to everyone. So, there are some steps you can take to correct it. Obviously, contact the credit bureaus if there's anything done. Contact your bank or credit card company if there's a fraudulent activity. They will, in most cases, reverse the charges, but it's just the pain you have to go through and the documentation a lot of times to make sure that everything is correct. And there is some insurance. You have to weigh that carefully, too, about the cost of the insurance and protection. Versus what they will actually cover, because what you think they may cover may not actually cover. So you really have to understand the policies a lot of times. Sometimes banks will offer these, deals that will protect you for $3 a month, but then when you find out what it actually covers, it doesn't cover a lot of those potential things. So, all right. Credit cards, a big thing mentioned this chapter. One of the things I think about the Obama administration, Elizabeth Warren, she's going to be the vice president, I don't know, but she brought about a lot of changes which were good for credit card consumers to help protect them. If you were to ask people in the banking industry, they would just say it's more regulation, but there were some unethical practices that were done by some companies in the credit card industry. I know Wells Fargo was in the news for other practices in the banking industry, but there were banks that did things like that, like literally even if you mailed the payment in on time, they would say they didn't receive it on time, and they would add extra interest and charges to your card. So these are very unethical companies, but they would do certain practices that they'd entice you to get into the credit card, very low interest rates. And I remember I almost went to work for a big one out of Delaware. I think it was MB&A at that time. And if you just were to miss like a trash payment or something like that for the month, if they found out about it, your interest rate could go from like 5% to 25% overnight. So people get trapped in those high interest rate cards. And once you start using that as a line of credit, it's very hard to get out of. So, the textbook also talks about some of the worst case, the payday loans. It was unfortunately in Overland Park. We had one of the largest corporations, a payday loan. I think the guy went to jail. I was watching a documentary on it one time, or something happened to him. But they're very engaged in very unethical practices that you would never actually pay off the loan, and they would do those things too. Not to apply payments. It would just continually evolve. So the government stepped in a lot of those things, places, and corrected. I don't think they allow payday loan places near military bases anymore to try to protect like young people in the military. So last thing I just kind of want to wrap up with credit cards, understand the details of the contract. You see those contracts and they're all kind of, they send you in the mail and it's all small print and nobody reads them, but you do need to understand. Ask the questions of the banker at least. What type of credit agreement are you getting into? What happens if you miss a payment? All these different things, and how is it applied? The textbook, when you make a payment, how is it applied to your balances? But in terms of personal loans, they're secured, unsecured. Those that have collateral, that don't have collateral. There's the annual percentage rate, and if you've taken a finance class, just a little refresher. The annual percentage rate is just a stated rate. Like if you were to go to Nebraska Furniture Mart and get their card, the annual percentage rate may say like 22% on the card. If you do not pay it off in the time that they offer you, like the 0% financing. And there's also the effective rate. Actually, in Excel, if you go into the EFFECT function, if you were to put in 0.22 as the interest rate and 12 as the number of periods in that year, you'd find the effective rate is actually much higher cost, probably about 24 to 25%. So you have to be really cautious about, especially when you're making installment payments, what's your true cost of borrowing. And they talk about different types of things. Uh, Borrowing for a car is probably one of the major things today. It just amazes me how expensive cars are these days compared to when I grew up in the 80s. But it's a major life purchase, so sometimes I wonder how people afford these cars. I see these new F-150s, 50, 60, 70, $80,000, and it's like, wow, how are people affording these? I guess they're putting all their money into their truck, and that they're living very frugal or minimally with other things. But I just kind of question, is that really how you want to spend your money? If it's important to you, I guess yes, but does it help you build up net worth? That's the big question, because cars, as soon as you drive them off the lot, they depreciate. So they're a point you get from A to B. We spend a lot of time, well, less time today with COVID-19, but you just got to be smart about it. And is this truly, again, going to make me happy? Is this going to improve my standard of living in the long run? Is this going to meet my financial goals? But I really like Edmunds. They give a true cost to own website. And I also want to mention too, I put out some documents out there from the course just to help you calculate loan payments. There's some spreadsheets. They're pretty dated. I have them for a long time, but they're still very effective to tell you what your payment would be like on a mortgage or a car loan. So some other things though to mention though too, may impact some of you, like the student loans. Obviously the federal government has student loans that are subsidized, unsubsidized, and there are banks that offer student loans too. Home equity lines of credit would be another way. That's probably something that I'm going to use with my son, depending where he goes to college. If we have to borrow, as long as the interest rates are low, it may behoove me just to borrow my home equity line of credit if we decide to do that. So anyway, that was it for this week. So I'm going to provide a summary. And if you do have any questions, do email me. But everybody's doing a great job, so just stay on top of things and have a great week. And we'll talk to you online.